Alright, good day everyone. This is United Hampshire REIT's FY 2023 financial results dated 22nd February 2024. Alright, so we'll just look at the US market update, right? So this really about what's going on in the US economy. The US economy is still strong, right? So real GDP growth is 2.5% year on year, right? January 2024 unemployment rate is low at 3.7%, right? And most importantly, the US inflation rate has gone down from 9.1% in June 22, right, to 3.1% in January 24, right? So this is a lot closer to the Fed's target of 2%, which means that it's likely that sooner rather than later, the Fed is likely to cut interest rates, right? Obviously, REITs are sensitive to interest rates, and cutting interest rates are good for it, right? So this is the US consumer spending behavior, right? So retail sales is marginally up, right? Grocery sales is up 2.3%, right? My hypothesis is that this is due to the fact that inflation is still hitting the US quite hard, right? So 3.1% inflation still means that things are 3.1% more expensive than last year, right? So I think eating in is probably a way to save money, right? And of course, if you are you don't have so much expendable cash, right? Things are getting more expensive. Discretionary sales, right, on things like furniture, electronics, sporting goods, musical instruments, right? Things like that should probably be cut back. So we expect to see a fall in discretionary sales. Right, so the REIT has done generally quite well, right? So grocery and necessity properties are up, sorry, not up, but very high occupancy at 97.4%, right? This shows very strong demand, right? Long WALE, high tenant retention rate of 92% since IPO. Basically, 92% of their tenants have been around since the REIT has started, which is good, right? So minimum lease rollover of 2.2% and 4.2% for the next 2 years, right? No refinancing required until November 2026, right? So this means their cost of debt shouldn't change too much until this time, which hopefully by then interest rates have come down, right? And refinancing will be cheaper, right? Okay, fixed rate debt has gone down slightly, but it's still quite high overall, so it's still a good thing, right? Triple net leases, that's a good thing. Built-in escalations for rental, as well as no early termination rights, right? So that's a good thing as well. The primary thing I'm very happy about is portfolio valuations have gone up 4.7%, right? This was a prediction I made the last video on United Hampshire, that I think the portfolio valuation should not go down because of the high demand of the REIT's nature, right? So they are actually in a space whereby basically it's essential services, right? People need to buy stuff from like groceries and necessities, right? And since the REIT is focused here, that I think the portfolio valuation should not be devalued, right? So that's a good thing, because this affects gearing, and gearing we know is a concern, right? So portfolio valuation going up, that's a very key point that I'm happy with, right? So this one we discussed the last round already. So they actually finished the construction early and in time for the peak end year festive shopping season, right? That's a good thing, right? So all these things just telling you that there's no demand issues, right? Portfolio valuations, like we said, is up 4.7% year on year due to strong operational performance. That's great, right? DPU is the point of concern for most investors, I believe, right? So 5.8 cents in the last financial year, but in this financial year only 4.79 cents. That's an 18.5% drop, right? It looks scary, but actually 0.45 cents is due to the fact that management choose to take its fees in cash, and the other part is to retain capital reserve. So the first part I would like to explain as the reason why they take their fee in cash is so that they don't have to give a lot of units to the management, right? Because the current price of the REIT is quite depressed, right? So if you give units to the management, instead you have to give a lot of units, and that in turn dilutes the REIT and is bad for the REIT long term. So I think taking the fee in cash whenever the REIT's price is depressed, right, is the right move. And secondly, retaining capital reserve is, I think, a good thing also, because in case in the near future they need money, which shouldn't be the case, but I think it's always good to have money in reserve, right? It's better that they are conservative and keep some money rather than distribute everything. Then later on realize that either they struggle to pay off a loan, or do some asset enhancement and get stuck, right? Like for example, other REITs like Manulife and maybe Keppel Oak, right? So they realize that their gearing is too high and they are worried about cash flow, right? So returning capital is always a good thing lah, especially during these times, okay, in my opinion. Right, moving on, right? So we look at their debt, right? So we already discussed this. It's a good thing. So the next two or almost 3 years, right? Almost 3 years that we don't have to worry about refinancing. But their weighted average interest rate will still go up slightly because they didn't fix all their debt, right? But it shouldn't be so significant, the increase, right? So the last time we checked, their weighted average interest rate was 4.04%, right? In the last video, it has gone up to 4.32%, right? So that's not really good, right? But good thing is interest coverage ratio has gone up from 2.7% to 2.9%, right? So that's a good thing, right? Aggregate leverage is the same as the last round, 41.7%, and this one is the real aggregate leverage because they actually do not have perpetual securities, right? So I'll just run a quick show you their balance sheet quickly, right? So this is the latest balance sheet, right? So you can see that normally if they have perpetual securities, they'll put it here, right? So you can see this their total assets and their total liabilities, all right? And net assets is total assets minus total liabilities, right? And perps will be sort of put somewhere here, right? So with no perks, that means that whatever they're reporting here as their leverage is actually accurate, right? So unlike REITs like maybe AIMS or Lendlease or Starhail Global, right? They have perps in their balance sheet, right? Which I believe should be calculated towards aggregate leverage, right? So 41.7%, right? Anything above 40 is not great, but at least they don't have perps, right? So that's the saving grace, and of course their asset price is going up, right? Which means that gearing should technically go down if the asset price carries on going up, right? So anyway, they are currently offering 9.7% yield roughly, right? Based off the price of 50.5 cents, right? Based off the current distribution, 4.79, right? So you can see that even if we consider the 18.5% drop, this is still giving 9.5%. And to me, the REIT that I will compare these two is actually FCT. Okay, of course, FCT to us is a much safer REIT. It's based in Singapore, and we can see the properties, and United Hampshire being overseas, we have to give some kind of discount, which means that we should expect a higher yield, right? So I think 9.5% yield is comfortable for me, right? Yeah, so I won't go through the rest because I think it's quite draggy. They really talk about a lot of stuff, right? Some of the stuff I discussed in the last video, so you could look at the last video for it, right? So just go through their income statement, right? I don't think there's too many things that I want to talk about. Yeah, so the DPU, right, like we discussed, year on year is dropping by 18.5%. The second half of the year 2023 versus the second half of the year 2022, right, the drop is quite significant, 27.9%, right? Just to let you know, right? The main reasons, okay, so this one I was just calculating how come the net income this round is so much higher than last round, but it's mainly due to one-off things, right? Like yeah, I'm not going to discuss it. I think it's not necessary, right? So yeah, we realize that the DPU drop is more significant in the second half than the first half, right? So some of you may be a bit concerned about that, right? Personally, I'm okay with the REIT's overall performance, right? The most important thing was I was worried about asset price dropping, and since the dividend even after the drop is still pretty high, I think there's some margin of safety, right? So this is the part I show you with no perps, right? So the balance sheet is relatively straightforward to read, right? I think that's all I want to show, right? Then there's the last document, right? So yeah, no refinancing, we talked about this. Yeah, so this was the part that we were talking about, right? Why the management take their fee in cash, right? So yeah, not much to say. They divested the last building at a 7.7% premium, right? So this is what I like to see when management is able to divest their buildings above their NAV, because this is purchase price, right? Okay lah, so I read wrongly. So purchase price, so they did make a profit on it lah. So this means that they probably didn't overpay for this center, right? So they said they are looking for opportunistic divestment opportunities to reduce gearing. Sorry for that. All right, so yeah, I think that's all I would say. Yeah, so the other part of their business is storage business, right, which is relatively high occupancy as well. Okay, and finally, yeah, their aggregate leverage is exactly this with no perps, and interest coverage ratio is slightly improved. Right, so yeah, I think that's all I will have for this read. Please remember, this is not financial advice, right? And thank you for listening.